Okay, so now it is the afternoon. Welcome again. And my apologies. It only took me 1 minute earlier to already make a mistake. The Bank of Canada Governor, Mark Carney, is actually speaking at 12:15. Oh, make that 12:26. We are pulling the staff out of the room, so for those, please do finish dinner. For those that have a dirty plate in front of them, that chocolate mousse thing in the middle won't hurt. Just stick it in the middle of your gravy. We'll be fine. My wife told me one thing today. She said, don't use cliches. So I was dying to say, with no further ado, here is, but I'm not going to say that. You know, what's made this event and the past 5 events successful is we've had some major partners who knew right from the beginning that it was important as a community on Vancouver Island to stay together, to talk, to communicate, and to work towards a future vision. And I'm really pleased to ask Adrian Legan from the Coastal Community Credit Union, a partner for 6 years, to introduce the Bank of Canada Governor, Mark Carney. Thank you.
Well, thank you, Dave. And welcome, everyone, to the Governor's Luncheon at the VIA 2012 Economic Summit. Now, before I begin, it has been said that Mark Carney is a rock star in the international economics world. So I've been asked to tell you that the use of Bic lighters is strictly prohibited in Vancouver Island Conference Center. On behalf of the Board of Directors and employees at Coastal Community Credit Union, I'd just like to say how thrilled we are to be able to partner with VIA to bring our Governor of the Bank of Canada, Mark Carney, to Vancouver Island. Coastal Community's vision is to enrich people's lives, improve financial health, and build healthier communities. We happen to do that through our personal and business banking, insurance, and wealth management divisions. Over the last 60 years, Coastal Community has become one of the largest employers on Vancouver Island and the Gulf Islands, and we were honored to be named 20th on the Aon Hewitt's list of the top 50 employers in Canada. We're the largest financial institution based on Vancouver Island, and we have more financial services branches than any financial institution north of the Malahat to better serve you. None of this would be possible without the incredibly hard work of our banking, insurance, and wealth management professionals in your communities who are singularly focused on your personal and business success on the islands. And all of us, like you, have been eagerly awaiting Mark. In addition to being Canada's top banker, Mr. Carney is the chairman of the Financial Stability Board, member of the Board of Directors of the Bank for International Settlements, member of the Group of 30, and on the foundation board of the World Economic Forum. Mark has actually been called wicked smart, and you just can't pay media to say things like that about you. I invite you to read more about Mr. Carney's exceptional experience and accomplishments in his bio. But as I said, like you, I'm very excited to hear what Mark has to say today, especially since he has just returned from the International Monetary Fund meetings in Tokyo. So without further ado, please join me in welcoming one of the most respected and influential economics and finance people in the world, our Governor of the Bank of Canada, Mr. Mark Carney.
Thank you all. Thank you very much, Adrian. It is a great pleasure to be here in Nanaimo at the I can't say it, Vancouver Island Economic Alliance Summit. And I've very much enjoyed meeting some of you over the course of the last hour, and I'm looking forward to your questions. I would like to note that my mother is in the audience, though, so keep those questions suitable for her. Part of the reason I really wanted to be here was both because of what you're trying to do, coming together to grow this economy, but also because of the orientation of this economy and the people who are here, which is outward looking. The orientation of British Columbia, which serves as Canada's gateway to Asia. And the reality is, in speaking to people here and over time, along with my colleague, and I should recognize Jacques Finlayson, who's on the board of the directors of the Bank of Canada, is here today, and another colleague, Laurie Renison, who's here, who helps run our British Columbia office out of Vancouver. There is an awareness here of the interconnectedness of the global economy. To the benefit of billions of people across the world, goods, capital, and ideas are now flowing across borders as never before. Unfortunately, so too does unease or angst, and that's my topic today. Même si la grande récession est derrière nous, elle a été suivie d'un processus peu familier d'assainissement des bilans publics et privés dans les économies avancées. La profondeur et la durée de cette réduction des leviers d'endettement ne sont pas connues avec précision. Mais la réduction de leviers d'endettement a pour effet de freiner la reprise mondiale ainsi que le mettre au jour des défis distincts dans diverses régions du monde. So we have this process of deleveraging which is happening around the world. It's creating distinct challenges. In the euro area, the economy is stagnating as it struggles with an underlying balance of payments crisis. The United States sits at the edge of a fiscal cliff. China and other emerging markets are trying to sustain rapid growth amid weak demand in their traditional export markets. There's a synchronous slowdown underway in the global economy. And this past weekend in Tokyo, when the IMF marked down its growth forecast, no region and no major economy was spared. Further, the IMF warned the downside risks to global growth have risen. So against this background, it's not surprising that we meet at a time where uncertainty over the global outlook is high. It's being reinforced, it has to be said, it's being reinforced by concerns over how policymakers themselves will address these challenges. And this combined uncertainty is further complicating the recovery, prompting firms and consumers to retrench. And there's some evidence of this dynamic here in Canada as businesses feel the weight of darkening global prospects. So with that, the point is that today's and tomorrow's summit is timely. I'm not going to be able to dispel all of these concerns in the next 20 minutes. But my objective is to explain how policymakers around the world are addressing some of the uncertainties and to put some others into their proper context so we in Canada and you here on the island can think about how to move forward. Now, it's only human to respond to uncertainty with caution. Faced with a highly volatile environment, households shy away from spending on big-ticket items like houses and autos, and firms put off making large capital investments and hiring new workers. And the effect on business investment in particular can be significant. And that's because uncertainty increases the value of waiting for new information when firms decide whether to undertake big projects. That uncertainty has such real effects is clear. However, the precise degree of uncertainty at any given point in time and its impact on economic activity is itself uncertain. So, for example, if you look at some financial market indicators, standard measures of financial market volatility, such as the VIX, which is a measure of volatility in the expected volatility in the U.S. stock market, or implied volatilities from option prices and other asset classes, the current environment does not appear to be particularly uncertain. In fact, many of these measures are at their post-crisis lows. However, the comfort offered by these market-based measures may be misleading. For one, they may be importantly influenced by the extraordinary liquidity provided by central banks. This liquidity has supported financial markets and thereby provided insurance against downside risks. Now, this dampening effect of central bank action may not persist if economic fundamentals do not ultimately improve, meaning that there could be a discontinuous shift in volatility at some point in the future. Moreover, if we look at trading volumes across asset classes, they've been generally low in recent months, as many participants with large cash holdings sit on the sidelines. Paralysis, not confidence, may better account for the observed declines in actual implied volatility. And this apparent lack of conviction in markets can itself be considered a sign of unusual levels of uncertainty. Other indicators, such as surveys of business and surveys of households and businesses, tend to be more consistent with what we all feel. For instance, a recent survey by the U.S. National Federation of Independent Businesses finds, and I quote, that uncertainty over economic conditions ranks second in the list of U.S. businesses, U.S. small and medium-sized businesses' most critical problems, and uncertainty over government action in the United States was fourth. Using another index of economic policy uncertainty for the U.S., constructed by researchers at Stanford, they estimate that the rise in policy uncertainty since the crisis began reduced the level of U.S. GDP by approximately 3%, that's almost $500 billion, with a loss of over 2 million jobs. At the Bank of Canada, we used a similar methodology to estimate the effect of an increase in policy uncertainty. Again, what policymakers are going to do and how effective it will be. We estimated what's the impact of this been in the euro area and found that over the last year, the level of euro area GDP may have been lowered by roughly 1%, or almost $200 billion. So that there's uncertainty about how the global economy will respond to an unprecedented period of deleveraging is not surprising, but what's troubling is the apparent uncertainty about the stance and perceived effectiveness of economic policy. And so I'm going to go through the three major areas in the world and talk about what policymakers can do about it before finishing up in Canada, what does it mean for us, and what we can do about it. So let me start with Europe. As I said at the outset, the euro area is stagnating. GDP is still 2% below its pre-crisis peak, and private domestic demand is a stunning 6% below. The reasons for this underperformance are deep-seated. Now, there's two ways, in our view, to address the uncertainties that are plaguing Europe. And the first, it's often said that Europe is suffering an existential crisis, meaning that the very existence of the euro is being questioned. Recent actions in the past few weeks, particularly by the ECB, are now directly addressing this risk. The ECB has introduced a new program that is specifically designed to eliminate the risk of euro redenomination. Simply put, subject to certain conditions, the ECB will act to ensure that yields on any particular euro area country's short-term government bonds should reflect only the credit risk of that sovereign, not the risk that the country will leave the euro. Now, I said simply put. That was simply put for a central banker. But they're going to isolate the risk that the country defaults, which is the responsibility of the country, the budget and the fiscal position of the country, from the risk that the euro will cease to exist or that the country will not be part of the euro. And so the ECB is attacking specifically, and in our view with great effect, specifically a core uncertainty in Europe. By lowering yields in this manner, the ECB will substantially improve the transmission of monetary policy and thereby increase the prospects for economic recovery in Europe. Now, the second thing that European authorities could do is to reframe the expectations of citizens and market participants regarding the time horizon over which European monetary union will be refounded. Now, you're no doubt aware from watching the news or reading in the paper that there have been a seemingly endless series of crisis summits held in the euro area over the last couple of years. It's 19 and counting in the past 2 years at the level of European leaders. Now, there has been important progress in these meetings, but there was never any chance that any one meeting could solve this issue. For Europe to be a viable currency union, several reforms over a 3 to 5 year period will be required. And these include necessary institutional changes, including the formation of a banking union, a closer fiscal union, including a fiscal transfer system and some form of mutualization of sovereign debt, measures to enhance labor market flexibility and mobility, as well as reforms to promote competition and productivity in product markets, and finally, steady reductions in budget deficits. By reframing expectations to a realistic time frame and ensuring that any financial assistance program for countries that are under adjustment, ensuring that those programs are big enough and sufficient enough for this period, European authorities could arrest this cycle of crisis summits and thereby reduce policy uncertainty. Now, turning to China. Growth has slowed across emerging markets at a greater than anticipated rate in recent months. In China, real GDP grew 7.6% in the second quarter, which is its slowest pace in 3 years, and recent data suggests a further softening of the rate of growth in this quarter. Now, the slowdown in China's growth reflects two broad influences. First, external demand for China's exports has weakened, owing largely to the recession in Europe, Europe being China's largest trading partner. But the second reason why growth has slowed has been past policy actions in China. Given that China has large vulnerabilities in their housing sector, they had increased evidence of overinvestment, they had inflation above target. Chinese policymakers a few years ago appropriately tightened monetary and macroprudential policies once the economy shook off the initial effects of the global financial crisis. Now, given this objective, the reduction in the growth rate in China to more sustainable rates is welcome. However, there are some signs that the recent slowdown in the Chinese economy may have become too intense, and this is prompting authorities to unwind some of their past policy tightening. This process has begun, with notable fiscal stimulus measures announced recently. But there's still significant uncertainty over how quickly China can adjust its growth model. With the limits of their export-led growth strategy now increasingly obvious, rebalancing their economy to encourage domestic sources of growth is needed. However, prior rounds of stimulus in China appear to stoke already very high levels of residential and business investment rather than consumption in China, which remains exceptionally low. So the risk is that as Chinese authorities ease, the right stimulus will end up stimulating the wrong places. For outside observers, the uncertainty surrounding the outlook in China is compounded by the difficulty of obtaining reliable information regarding the extent to which the economy has already slowed. But I think we need to put uncertainty about China into context. The Bank of Canada expects China's GDP growth to average about 7.5% over the next few years. While this is substantially below the unsustainable double-digit rate seen in recent years, it's still considerable. Let me put that into perspective. 7.5% growth in Chinese GDP in 2012 will add roughly $800 billion, that's more than half the size of the Canadian economy, roughly $800 billion US dollars to the global economy, at an amount which is an amount equivalent to what China added to the global economy when it was growing at 14% in 2007. That $800 billion, said another way, that $800 billion that China will add to the global economy this year is more than twice the dollar value of growth in the United States this year. So let me turn to the U.S. The recovery there remains modest, something that's consistent with the experience of other advanced economies that have suffered financial crises. Although fiscal challenges continue to loom, it has to be said that the recovery in the U.S. now appears to be on somewhat surer footing. American households have recovered more than two-thirds of the $16 trillion in net worth lost in the aftermath of the crisis. And while it will take several more years to make up the balance, the process of household deleveraging, the repair of household balance sheets in the U.S., appears well advanced, particularly now that the U.S. housing market is beginning to recover, something I know you watch closely. In addition, major U.S. banks have substantially increased their capital, and U.S. corporate balance sheets are very strong. So that's the good news. There's substantial progress in the private sector in the United States. Despite this, aggregate debt across all sectors in the U.S. has not budged from its peak of 250% of GDP. The burden of deleveraging in the U.S. has, in a sense, been transferred from the private to the public sector. And it's absolutely clear, I think, to everyone, including U.S. authorities, that U.S. public debt needs to be reined in over the medium term. What's less clear is precisely how. Existing legislation in the U.S. incorporates automatic tax increases and spending cuts, which are set to kick in at the start of next year. These amount to 4%, roughly 4% of GDP, and this is the so-called fiscal cliff. If American authorities do not change these provisions, this massive fiscal drag will likely push the U.S. economy back into recession next year. Now, that's not what we expect, but like others, we can't be sure. There is evidence that uncertainty surrounding the resolution of the fiscal cliff is already having an adverse impact. So as I just mentioned, while the general tone of U.S. data of late has improved and financial markets are holding up, higher frequency indicators related to U.S. business investment, the area where you'd most expect uncertainty to have an impact, those indicators have weakened. Now, the U.S. assumes that the bank assumes that the U.S. will step back from the fiscal cliff in the end. But in any scenario, however they do that, they will still need a clear, consistent, and committed medium-term fiscal plan, one which demonstrates how this consolidation will be achieved, would be very helpful in mitigating a major uncertainty which would otherwise endure. Now, more positively in the U.S., recent actions by the Federal Reserve have substantially reduced uncertainty. Specifically, the Fed has provided greater certainty by indicating that its policy rate could be expected to remain at exceptionally low levels until the middle of 2015. It's also provided more certainty with respect to its so-called reaction function, how it will react to economic outcomes in the future. And it's provided more certainty by linking future unconventional monetary policy to, quote, substantial improvements in the outlook for the U.S. labor market. In addition, the Fed has indicated that it will leave highly accommodative policy in place, quote, for a considerable time after the economic recovery strengthens. So if conditions were to deteriorate and further easing were required, in our view, the U.S. Central Bank could provide even greater certainty by providing further refinements, such as precise numerical targets and a time frame for achieving those targets. Now, the Fed didn't just sharpen its communications in recent weeks. It also announced its intention to purchase $40 billion in securities per month, additional over the next few months, but $40 billion in securities per month, a strategy that has been nicknamed QE3. As with previous rounds of monetary stimulus, QE3 can be expected to support the American recovery, both directly by lowering interest rates and more broadly by the so-called portfolio balance effect. Now, this channel, the second channel, the portfolio balance effect, tends to lift asset prices and reduce the value of the U.S. dollar. But the overall impact of QE3 for Canada is estimated by the bank to be modestly positive, reflecting its supportive implications for U.S. and global activity and the resulting associated boost for commodity prices. So what does all this mean for Canada? Elevated global uncertainties holding back global growth and thus demand for Canadian exports. That is clear. In addition, there is some evidence that global uncertainty is affecting domestic activity. According to the bank's most recent quarterly business outlook survey, which was released just this morning, Canadian firms have become more circumspect about new capital expenditures and slightly less inclined to hire new workers. In this new environment of slow global economic growth and uncertainty about demand, firms have also tempered their sales expectations for the next 12 months. Now, it should be clear that in all cases there's an expectation of slightly that this is not an indication of outright lowering of sales or outright lowering of reductions in capital expenditures, but just that the rates are not going up. So we're in a situation where our economy is being affected by global events, but it should be recognized that the key areas of uncertainty abroad are all points of justifiable confidence here at home. Canada's public finances are sound. Our monetary policy is clear and credible. Canada's financial system has shown itself to be the most resilient in the world throughout the crisis, and since then, it has strengthened further. The one thing Canadian businesses can expect is that their financial system will be there if times get tough again. In this uncertain world, Canada is rightly viewed as an attractive investment destination. This is having an important effect on Canadian financial conditions. Capital inflows tend to push up the value of our dollar, thus acting as a headwind for the Canadian economy. However, foreign capital is also tending to push domestic asset prices up and longer-term interest rates down, which has a supportive effects on domestic growth. The bank obviously takes all of these factors into account when setting monetary policy. What the bank tries to do is to provide as much certainty as we can regarding the conduct of monetary policy. We obviously cannot determine events abroad over which we have no control, but we can be transparent about what we expect and what we would do, how we would react to different scenarios. And that includes being clear about the role of monetary policy in supporting financial stability in Canada. For example, if we were to lean against emerging imbalances in household debt, we would clearly declare we are doing so and indicate how long we would expect it to take for inflation to return to the 2% target. So let me conclude. You're probably happy that I'm concluding after all that. 80 years ago, faced with a more dire set of economic circumstances than we are today, Franklin Delano Roosevelt famously told Americans that the only thing we have to fear is fear itself. But this, today, is not the Great Depression. The IMF expects the global economy to grow more slowly than it did 6 months ago, but it expects the global economy to grow slightly more than 3% this year and next, or just under the average of the last 10 years. What we face now is better described as uncertainty than fear. The spirit of FDR's comment applies. We must take care not to allow uncertainty to dominate our actions. We must not let profitable opportunities slip away and more generally compound the very real but still manageable challenges facing the global economy. As Canadians, we need to focus on what we can control. We can't fix the euro. We can't fix the U.S. fiscal cliff or restart the U.S. housing market. The question is, should we just wait out a decade-long deleveraging process in the crisis economies like the U.S. and Europe? Should we lower our expectations, or should we control our destiny by building on our strengths in a new global environment? We can improve Canada's low productivity growth, we can sharpen our focus on emerging markets, and we can continue to invest in our greatest resource, which is our people. And I think that's the essence of the discussions that you're going to have once I leave, basically, over the course of the next day. Against this backdrop, next week's monetary policy report from the bank will provide a full update on the bank's outlook for economic growth and inflation in Canada and abroad. Our report will take into account the impact of the uncertainty that I've been discussing today, and I can assure you that the bank will take whatever action is appropriate to achieve the 2% consumer price inflation target over the medium term. That certainty is our contribution to ensuring that Canadians can invest and plan with confidence. So thank you very much. I'd be happy to take any questions.
Governor, thank you very much. We're going to send a couple of microphones out into the crowd. Jody, I believe, is going to take the other one. There. Hi. Or I'll use this one.
Use that.
We're going to give you an opportunity to ask a couple of questions. The governor has a little bit of time to do that today. So Rob Bai is going to go into the audience, and Jody Beck will as well. We would just ask that you keep it to one question per person, because we're kind of on a timeline here. Please identify yourself and your affiliation when you stand up to ask that question. And without further ado, Rob has a question there. Thanks.
Governor, welcome to Nanaimo. I'm Sasha Angus, the CEO of the Nanaimo Economic Development Corporation. You're in good company. Glenn Hodgson, who's the chief economist with the Conference Board, also has his mother in Nanaimo, so thank you for that. Next time you guys want to come and fulfill your sonly duties, just let us know and we'll be happy to host you again. I had a quick question. A lot of our companies are exporters, whether it's tourism, technology, increasingly international education. So at $1.02 American right now, maybe some more thoughts on the level of the Canadian dollar and perhaps the investment that our local companies can make in productivity to help offset the that headwind you spoke of.
Yeah. Okay. Well, great question. In terms of our currency, we have seen and you have felt persistent strength in the Canadian dollar over the course of the last several years. It's one of the headwinds on our economy. It's one of the reasons why monetary policy is as accommodative as it is. I mean, I think we have to remember that one of the differences in Canada versus other major economies is we have a financial system that is functioning very well, and so when we have the overnight interest rate at 1%, that really does quickly translate through to the effective cost of borrowing for our firms. As you indicate in your question, Sasha, one of the consequences of a strong currency is on the cost of investment goods. A lot of investment goods are imported, which creates an opportunity, obviously, to boost productivity. And we have seen evidence of firms taking advantage of that across the country, manufacturing sector in particular. Given where productivity is in Canada at the moment relative to our major competitors, not just the United States, but also including, say, Mexico, for example, we have a sustained need as a country to continue that investment, and it's important, therefore, we think, to put global uncertainty in context. The last point, which is that you referenced rightly international education, which is a tremendous education. Full stop is a tremendous strength of our country. It's a tremendous strength here on the island, and leveraging that internationally is a growth area for the country, both in terms of obviously students coming here, and I know there's a lot of that, distance learning, curriculum, using Canadian curriculum internationally. In general, the biggest growth areas, as you know, are major emerging markets. I'll use China as a specific example, but major emerging markets. And over time, to bring it back to the currency question, over time it is reasonable to expect that the values of those currencies are going to appreciate relative to the Canadian dollar, which is going to continue to make us more competitive and effective, and make that activity even more beneficial for the island and the Canadian economy. So with a medium, longer term horizon, that is one example of an area that merits continued focus and for good benefit.
Thank you, Governor. Anyone else who has a question, please just stand. And we have one back there. Hang on a second. We're going to go back there first. Thanks.
Thank you, Dr. Carney. My name is Christopher Payne. I'm the Manager of Revenue with the City of Victoria. I don't have a question about local government, but I've been dying to ask an economist this question for 4 years, so thank you for being here today.
If I find one, I'll let you know.
So I just wanted to paint an economic picture that is concerning to myself, and I want to know how Canada's outlook is with respect to this question. So in the wake of the financial crisis, we saw governments around the world respond unprecedentedly with fiscal stimulus. At the same time, central banks responded with a monetary policy, increasing the money supply. In particular, I look at the United States. You mentioned quantitative easing 3, QE2, QE1, Operation Twist, numerous monetary policies. At the same time, I look around the world where the U.S. dollar is being dropped as the reserve currency. So if I were an American citizen, I would be particularly concerned about inflation. So my question for you is, at the same time, the Central Bank of Canada has not monetized its debt indirectly or directly. So my question for you is, if and when inflation happens in the United States to a stronger degree than it is now, is the Canadian economy hedged in any way because our dollar has not been devalued? Thank you.
Thank you. Wow.
Yeah, we don't need to repeat the question. We'll just go with the answer here.
It's not a multiple choice. No, I think the important thing, there's a few premises in there, that I would slightly challenge, but I'm not sure we have time to go through all of them. I think to go to the core of it, and let me say, just as a general statement, that we absolutely understand and support we understand why the Federal Reserve has done what it has done, and we support what the Federal Reserve has done. This is absolutely in a deflationary environment. We are in a global deflationary environment. The U.S. is in a deflationary environment. The risk has been that prices will fall and that debts will skyrocket. The effective cost of debt for individuals will skyrocket as a result. Think of you own long-term mortgage debt and all of a sudden your wages are outright falling, or you have mass unemployment because of deflation. The burden of that debt becomes absolutely unsustainable. So the Federal Reserve has done the right thing, absolutely full stop in our view. And it has been net positive for Canada. We do get headwinds because of the currency, but we get more benefit from the level of activity in the U.S., which flows through to Canada. But your question, which is an important one, is what happens down the road, and there could be lots of reasons why inflation goes up globally. Wouldn't expect it imminently from any stretch of the imagination, but down the road. And the important thing is, by dint of having a flexible exchange rate, we can run an independent monetary policy in Canada, and we can deliver. We have to take the right decisions as the bank, but we can deliver our inflation target. And our mandate in the end on the monetary policy side is very simple, which is to do exactly that, to ensure that inflation is averaging around 2% total CPI inflation in Canada. And so we'll conduct monetary policy to ensure that, irrespective of what happens outside of our shores.
Thank you. Probably time for one more down front here, I believe. See, we got about 5 minutes left, I think. Does that sound right? Thank you.
Yes, Ron Candlin. I'm the MLA for Parksville Qualicum. I understand your mother is my constituent, and I want to assure you that if she has any concerns, I will certainly be happy to look after them.
And that goes for everyone.
What's the question?
Right.
Yeah. Mr. Carney, certainly the forest industry needs investment here, capitalization both in sawmills and pulp mills. They need to modernize, they need to be able to take advantage of opportunities, and they need to recapitalize in order to keep the jobs here, to create the wood products and refine, so we don't have to ship so many raw logs. So my question is, how do we get some of that dead money that you called out of the hands of corporations and into investment in recapitalization of the forest industry? And a corollary, is there a role for government to play in terms of incentives, dividend incentives, or other roles that governments could play?
You are in government, aren't you, Ron?
Yes.
Just a private matter, okay. Okay. Well, I think the first point is that overall outlook for the forest product sector, which has been extremely difficult for a number of years. You feel it here in the island. We're certainly well aware of it. I think the slightly better news, and I don't want to overplay it, is that in our view, the U.S. housing market has stabilized at a very low level and has started to grow again. Our expectation is that will continue over the course of the coming years. So, again, starting from low levels, but moving up, U.S. housing starts we see rising towards 1 million by the end of our forecast period. So that's something. We got a strong dollar, which helps with imported capital equipment. I think in terms of putting money to work, what we're trying to do is be absolutely clear as possible about where the uncertainties are, where they aren't, and I just tried to be fairly clear about our expectations for the U.S. housing market, which is a key. It's not the only driver, but it's a key driver for forest products. Working with our federal partners, OSFI, the government, et cetera, making sure the financial system continues to be there so that firms can invest over the medium term and know the bank will be there. Monetary policy, that's the other way we influence it, which is, nobody's earning their cost of capital when interest rates are 1%. Nobody. And if you're a shareholder in one of those institutions, eventually you say, well, give me some of that back or put it to work. And so that's part of how we're encouraging as well. Then government, those are questions for government, provincial and federal, if something else is required. Although I would note that at least on the federal side, there has been accelerated capital cost allowance, which is a way of accelerating depreciation if you make an investment, which makes it more tax effective. That's been put in place over the course of the last couple of years, and that's an example of the type of thing that can encourage companies to put money to work. Okay.
Thank you. Thank you, Governor, for answering the questions. Should point out, too, by the way, not only does the Governor have family on the island, he has done the minivan drive with the kids to the West Coast and back, so he is one of us, really. He is an islander. I'd like to welcome back Adrian Legan, the CEO of Coastal Community Credit Union, to give thanks to the Governor. Thank you.
Well, thank you very much, Mark. I can't think of a more fitting way for us to start off the next 2 days of work that we have. You've outlined very clearly some of the continued headwinds and challenges we have, but I also made some notes of some of the optimism you have in the areas of continued Asian growth, the American housing market. So thank you very much. On behalf of VAIA and all of us here, we have a little gift from you, some treats from one of our island treasures, St. Jean's Cannery. Excellent. Thank you very much. Thank you very much.